Hi there, it's Bernhard Koepp at CJ Lawrence. Well, it's been another down week for the S&P 500. Couple of big events this week. Obviously this morning we got the surprise news that we have more tariffs going out in Mexico again this time. We thought Mexico was more or less resolved given the renegotiation of the old NAFTA, but it seems that was not the case now. So the market, technicians are starting to look at, where we are. I'll just turn the camera around and show you what we're looking at. If you bear with me here, we're still working on our technology here. So if you look at the S&P 500 right now, so we basically from the May high, that was sort of May 1st, we're down about 6% from that high, and we're right on that 200-day moving average. So if you pull back a little bit, that 200-day moving average, that's the long-term trend of the market. So when you start breaking that, people start getting a bit nervous. I mean, the other technical point that people look at is the 50-day line. That's this one. This is still way above the 200-day line, so there's no technical breakdown here. If we go back to remember the Christmas Eve sell-off, that was back down in here. So this move from December 24th through May 1st, that was a 19% rise in the market, and it's also that basically retraced the high or the peak to trough. If we go back to October 2nd, that was the high. When we went down 24, that was basically 19% down. So we've taken 6% away from that. So year to date, we're still up about 12% in the market. So that's still in positive territory. I'm not worried about the market breaking the 200-day line, but certainly here the market needs to find some grounding here. If we look down at volume, that's another thing you want to watch in corrections. We're not seeing a massive volume spike here. If you look at back here in December 24th, we had a massive volume spike. That's typically when volume is sort of an indicator of emotion. If volumes are spiking, that is a high emotion kind of day for the market. We're not seeing that. It's also volatility. The VIX is coming down, so that all looks okay. But certainly we want to worry about is the market going to break down here and kind of retrace some of these lows that we've seen before. So the other big news that we saw or that occurred during this week was if we look at Treasury yields, just to show you that picture, this is the yield curve. So what happened in the yield curve, we basically saw yields invert. So that is showing you the short rates that you see here, which are 3 months or 6 months rates, are now above the 10-year, which is here. So this bottom chart here that you're looking at is where we are currently. So the 10-year is now quite clearly below the short-term or Fed funds. So that should make the Federal Reserve very nervous, certainly about what to do. There's no way the Federal Reserve can raise rates in this environment, so now the market is pricing in rate cuts. That is obviously surprising if you think about the fact that we were the kind of the main narrative in the market is that the economy is actually doing well. Certainly if the Fed is lowering interest rates, that is not an indication that they think the economy is doing well. So if you see this chart here, the top one, that was where we were a year ago. So you can see what's happened to interest rates over the past year. They've come down a lot. This is very unexpected given that the narrative was that things are strengthening. So I'll turn the camera back around. We will continue to work on our technical skills here, but we're trying to show you what we're looking at. So, economists now are actually ratcheting down their expectations. So we're seeing that already. Some of the very prominent economists that we follow are certainly getting more cautious. the dollar is rising versus other currencies. That creates all kinds of dislocations around the world. The yield curve inversion is very bad for banks. You're seeing that play out in Europe. I mean, if you look at the way banks are trading in Europe, it's pretty dismal. So our inclination is to be underweight banks. We have just a few positions left in the portfolio. All year, we've been cognizant of the business cycle, so we've been actually fading what we call the macro trade. So, in an expansion, typically you want to overweight more economically sensitive stocks earlier in the cycle and then fade them at the end of the cycle. So, we've already been eliminating positions in things like semiconductors and going more underweight banks. We don't have exposure really into materials and chemicals and things like that. That's something we tend not to do in a major way. So retail stocks were in the focus this week. We saw a lot of earnings. The strange thing in the market right now is consumer sentiment is at an all-time high. So the consumer is still quite doing well. But you looked at earnings, the quarterly earnings reports. Most of the retailers are now complaining about the tariffs. So the tariffs are starting to eat into margins or expected margins. So we had a couple of stocks miss in the last week. Our specialty retail stocks that we own, things like Costco, Ulta, are doing very well. I mean, Amazon is certainly still is a retailer as well, an online retailer doing very well. So you have to be very, very selective in this environment. The key to success in this retail environment that is now tainted by tariffs is you need a company that has pricing power. So if you're losing share, if you don't have pricing power, forget it. You're going to get crushed, and your stock is going to be valued at a very low multiple. So we tend to focus on stocks that have real secular growth and are taking market share. So it was interesting to us. Ulta is a stock that we own for our more growth portfolios. That was one of the few stocks that was actually up today. And Costco came down with the market as well, but it had terrific earnings. So we're quite happy to be in those types of names. So the tariff tussle is now a full-blown warfare. Certainly the Mexico tariffs that were announced today were a big surprise. We've been very consistent to say that using tariffs as a policy tool, either on the economic front or on the foreign policy side, is a very risky approach. It was our base case that the tariff war with China would be resolved at some point. At this point, we're starting to question that. So we are rethinking some of our positions, certainly relating to stocks like Alibaba that we've carried for a number of years that we've liked in the past. So tariffs do matter, which is our key message here. So look, we're living in a strange world here. Not to say the least that we're seeing this not only play out in the markets. In the NBA, we have a Canadian team that's in the finals. I thought I'd never see that in my lifetime. So it's definitely an upside down world. We are continuing to watch these markets and invest your money. If you have any questions, do give us a call, and I'll see you next week.